Welcome to the Nifty Noon podcast.
We're really thrilled you could join us today.
Yeah, if you're listening to this, you probably already know that keeping up with the intersection of crypto, traditional finance, and tech, it can sometimes feel like trying to drink from a fire hose while standing in a hurricane.
That is definitely an accurate description of this past week.
Right. So our mission for this deep dive is simple. We are going to unpack a massive, honestly chaotic week of daily news pulled straight from our newsletter, Nifty Noon. We've done the heavy reading, the highlighting, the cross-referencing all, so you don't have to.
And looking at the stack of sources we are diving into today, if there is a single takeaway for the week, it's that we just witnessed a masterclass in extreme contrast.
Extreme contrasts. Unpack that a bit.
Well, on one side of the ledger, we saw some truly brutal macro-induced market washouts. Just events that left retail traders completely reeling. But on the other side, we saw massive, undeniable structural wins for the industry. The overarching theme here is the rapid blurring of the lines between traditional finance, what we call TradFi, and digital assets.
And all of this is happening right alongside the very real, sometimes really painful growing pains of rapid scaling and decentralization.
Exactly.
I mean, it's basically like watching a futuristic skyscraper being built, but the construction crew keeps arguing over the blueprints while a tornado hits the site.
That's a great visual, and that is exactly why you should care about the timeline we're about to walk through, because it is incredibly easy to get caught up in the daily price action.
Oh, for sure. You stare at the charts, you see the red and green candles, and you panic.
Right, but that's just noise. The real story, the signal hidden beneath all that daily volatility, is how the underlying plumbing of global finance is literally being rewired right in front of us.
Okay, let's unpack this chronologically. We are starting with Monday, February 23rd. The week kicked off with what I can only describe as a governance bombshell.
The decentralization dilemma.
Exactly. BGD Labs, who are basically the primary architects behind Aave's V3, which is widely considered the crown jewel of the protocol, they announced they are officially leaving the Aave DAO effective April 1st.
Which is huge.
It is. For someone who knows Aave is a big deal but maybe doesn't follow the internal politics, why is losing BGD Labs such a shock to the system?
Well, to put it in perspective, Aave is essentially the central bank of decentralized finance. It's the largest lending protocol in the world. Losing a core engineering team of this caliber, it's like Apple suddenly losing the entire hardware design team behind the iPhone.
Wow.
Yeah, BGD Labs didn't just maintain the protocol, they built the engine that currently powers it.
And the details of why they are leaving are what really caught my eye. BGD Labs cited an asymmetric organizational scenario. They pointed specifically to growing centralization risks with Aave Labs.
Right, the tension over Aave V4.
Exactly. It sounds like tensions really hit a boiling point over that upcoming transition to V4. BGD felt that V3 was being actively deprioritized and that existing contributors simply weren't being incentivized or, properly involved in the new design process.
They actually described Aave Labs' approach as adversarial.
Adversarial, that's a strong word. Though they did offer a $200,000 security retainer through June to ensure a smooth handoff.
Which is professional, at least.
Right. But wait, isn't that a massive contradiction? How can a project claim to be a decentralized autonomous organization, a DAO, if a single core team leaving causes this much internal chaos?
That is the million-dollar question, and it perfectly illustrates the complex challenge of scaling a decentralized protocol. When a project is new, everyone is aligned. You have a small group of coders with a shared vision.
Sure.
But as these pioneer DeFi projects grow into multi-billion-dollar behemoths, severe friction naturally emerges. You have this constant tug of war.
Between what, exactly?
Well, on one side, you have the foundational, purest decentralized values. Open contribution, community governance, flat hierarchies.
The ethos of crypto.
Right. But on the other side, to compete globally and push major updates like V4, you need coordinated, centralized brand and product management.
So it's the classic startup scaling problem, just multiplied by 1,000, because the entire organizational structure is distributed across the globe.
Exactly.
You can't really design a sleek, unified product by committee.
Or, well, it's incredibly difficult to do so efficiently. This internal crisis at Aave highlights a broader industry issue. Maintaining true decentralization while pivoting your strategic focus and managing a brand is a tightrope walk. And right now, Aave is wobbling on that rope.
So if Monday was a slow-moving existential governance crisis, Tuesday brought a violent, immediate reality check.
A total bloodbath.
Tuesday, February 24th, Bitcoin plunged over 5% down to the $62,500 level. It completely wiped out its weekend gains.
And the collateral damage in the derivatives market was what really made headlines.
We saw roughly $468 million in crypto futures liquidated.
Which is massive.
And to put a human face on that number for you, there was a single liquidation event on the HTX exchange where a massive $61.5 million BTC USDT long position was forcibly closed. One position.
61.5 million.
I can't even imagine the notification that trader got on their phone. Talk about a bad Tuesday.
And it's important for you to understand how that actually works. When a position that massive gets forcibly closed, the exchange automatically sells those assets into the market to cover the debt.
Which drives the price down even more.
Exactly. That sudden massive sell-off pushes the price down further, which triggers the next guy's liquidation and the next. It's a cascade.
And that cascade is why the crypto fear and greed index plummeted down to a reading of 5.
Extreme fear.
Extreme fear. To give you some context on how rare that is, a reading that low has only been matched 3 times since the index was created in 2018. We even saw BitDeer, a publicly traded mining company on the NASDAQ, fully liquidate its 943 Bitcoin treasury just prior to this to free up liquidity.
Which tells you a lot about the macro environment.
Right. Looking at the broader macro environment, we have to note that this market reaction was directly tied to the announcement of a 15% worldwide tariff by U.S. President Donald Trump.
And just to be clear, we are simply reporting the macro drivers here.
Absolutely. Regardless of the politics involved, we are just conveying the facts from the source. Markets historically react to sudden shifts in global trade policy with immense volatility.
Taking a step back, this proves just how tightly correlated Bitcoin has become with traditional U.S. equities, specifically in the software and private equity sectors.
Which is ironic, right?
Totally. Bitcoin originally pitched itself as an uncorrelated asset, digital gold, a safe haven. But in reality, when traditional markets get spooked by macroeconomic policy shifts like a global tariff, Bitcoin often behaves like a high-beta tech stock.
Let's pause on that term. For our listeners, what does a high-beta tech stock actually mean in this context?
Beta is just a measure of volatility compared to the broader market. If the S&P 500 drops 1%, a high-beta stock might drop 3%.
Got it.
Bitcoin acts like a hypercharged tech stock. When liquidity dries up or fear enters the broader economy, institutional investors dump their riskiest, highest beta assets first. The risk-off sentiment bleeds directly over from Wall Street to crypto.
Which brings us to a really fascinating, albeit scary, metric from the sources. The Sharpe ratio for Bitcoin fell to negative 38.4. Now, for our listeners who aren't deep in the weeds of financial modeling, what exactly does that ratio measure, and why does a negative 38 sound so terrifying?
The Sharpe ratio is basically a way to measure risk-adjusted return. It asks a simple question. For every unit of risk I'm taking by holding this asset, how much reward am I getting?
Yeah.
A positive number is good. A deeply negative number, like negative 38.4, means that the asset is experiencing massive downside volatility without compensating the investor with any returns. It means holding it feels terrible.
But earlier you talked about separating signal from noise, so if you're an over-leveraged trader, Tuesday was the noise that wiped you out. But what is the signal here?
The signal is what a severely depressed Sharpe ratio historically precedes. For long-term believers, a Sharpe ratio plunging to these depths often marks major, historically low-risk accumulation zones.
The ultimate contrarian indicator.
Precisely. The weak hands and the excessive leverage get flushed out in that liquidation cascade we talked about. That creates a much healthier, unleveraged foundation for the next leg up once the macro dust settles.
The ultimate be greedy when others are fearful moment. And speaking of being greedy, while retail traders were panicking and getting flushed out on Tuesday, Wednesday showed us what the big institutions do when there's blood in the streets.
They go shopping.
They go shopping. The theme for Wednesday, February 25th, crypto eats TradFi.
The contrast day over day is just incredible. Retail is fearful. Institutions are building infrastructure.
Case in point, Coinbase announced they're rolling out 245 commission-free stock and ETF trading to all of their U.S. users. They are directly targeting the Robinhood demographic.
And they aren't doing it quietly.
Not at all. They've partnered with Yahoo Finance to integrate a direct trading button right onto Yahoo's asset pages. So if you're reading an article about a stock on Yahoo, you can click a button and buy it instantly through your Coinbase account.
Which is a brilliant top-of-funnel user acquisition strategy. They are meeting the retail investor exactly where they already are.
But Kraken arguably took it even further. They are taking traditional equities and bringing them on-chain. Kraken launched 247 tokenized equity perpetual futures for non-US clients.
This is huge.
We are talking about tokenized versions of Apple, Tesla, the S&P 500, trading around the clock with up to 20x leverage. Okay, pause. Tokenized equity perpetual futures. That sounds like something out of a cyberpunk novel. Can you break that down for us using a simple analogy?
Sure. Think of a perpetual future as a side bet on a stock's price that never expires. You aren't actually buying a share of Apple. You are entering a contract that tracks the price of Apple.
Right.
And to keep that bet open indefinitely, you just have to keep paying a very small recurring fee. Kraken is taking this concept, putting it on a blockchain, and letting people trade it 24 hours a day, 7 days a week.
So why would someone in Asia, for example, want to trade a synthetic version of Apple stock on Kraken instead of just opening a traditional brokerage account?
Friction. Opening a traditional brokerage account across borders involves massive regulatory hurdles, currency conversion fees, and you're restricted to the opening hours of the New York Stock Exchange.
Good point.
On Kraken, if you have crypto, you can get exposure to Apple's price movements on a Sunday afternoon with zero friction.
And as if that wasn't enough consolidation for one day, Bitwise also announced the acquisition of Chorus One, an institutional staking provider that already has over $2 billion in staked assets.
Just massive land grabs everywhere you look.
So what is the broader implication here? Why are crypto companies suddenly so obsessed with traditional stocks?
Because the business model is evolving. These platforms realize they can't just be crypto exchanges forever. They are racing to become everything exchanges.
Everything exchanges.
Yeah. This structural blending of traditional finance and digital assets isn't just a gimmick. It's the creation of a massive new capital pipeline. By offering familiar assets like the S&P 500 alongside Bitcoin and Ethereum, they are building the infrastructure that could drive unprecedented new capital inflows into the broader crypto industry over the long term.
It's the Trojan horse strategy. Get them in the door to trade Apple stock and keep them around for the DeFi yields.
Exactly.
And that transitions us perfectly to Thursday, February 26th. If Wednesday was about exchanges absorbing traditional stocks, Thursday was about the underlying blockchain tech, proving it is quite literally printing money. We're calling this the stablecoin renaissance.
And amidst all the noise of liquidations and DAO drama, this might actually be the most fundamentally bullish news of the entire week.
Circle Internet Group, the company behind the USDC stablecoin, reported an absolute blowout fourth quarter for 2025. We're talking a net income of $133.4 million and total revenue of $770 million.
Staggering numbers.
That is a 77% surge year over year. And it's driven almost entirely by the adoption of USDC, whose circulation grew by 72% to hit $75.3 billion.
$75 billion.
The traditional market loved it. Circle stock jumped nearly 30% on this news alone, completely defying the broader digital asset meltdown from earlier in the week. But for someone listening, how exactly is Circle making $770 million just by issuing digital dollars that are always worth $1?
It's actually a beautifully simple business model when interest rates are favorable. When you give Circle a real US dollar, they give you a digital USDC token. Circle takes your real dollar and puts it into short-term US Treasuries or cash equivalents.
Okay.
You hold the token, but Circle keeps the yield generated by those treasuries. When they have $75 billion in circulation, even a modest yield generates a staggering amount of revenue.
And their reach is only expanding. We got a scoop that Mark Zuckerberg and Meta are eyeing a stablecoin comeback in the second half of the year, looking for a third-party vendor to power payments across Facebook, Instagram, and WhatsApp.
Think about the implications of Meta plugging a stablecoin into WhatsApp. You're talking about a borderless, instant settlement for billions of users.
The scale is hard to comprehend.
The remittance market alone, people sending money home to their families in other countries, is massive and currently plagued by high fees and slow transfer times. A stablecoin on WhatsApp solves that instantly.
But Meta has tried this before with the Libra project and got absolutely crushed by regulators. Why is now different?
Because the regulatory landscape has shifted dramatically. We have to look at the Pro-Crypto Genius Act, which is currently providing a much clearer U.S. regulatory framework.
The rules of the road are finally being written.
Exactly. Because of that clarity, stablecoins are graduating. They're transitioning away from merely being speculative trading pairs on crypto exchanges, and they're becoming the institutional-grade foundation of the global financial ecosystem. If Circle can simply maintain its target of a 40% compound annual growth rate, They are perfectly positioned to capture a huge chunk of global payment market share.
It really makes you realize that while everyone argues on social media about the price of Bitcoin, stablecoins are quietly conquering the world's transactional infrastructure.
They really are.
But as we mentioned earlier, it wouldn't be Web3 without a stark reminder of the risks. So let's wrap up the daily timeline with Friday, February 27th. We have to talk about the dark side of hypergrowth.
Yes, a very sobering cautionary tale about the immaturity of the space.
Blockchain investigator Zach XBT dropped a bombshell alleging insider trading at a company called Axiom. Now, Axiom is a highly successful Y Combinator-backed Solana trading terminal.
Right.
The allegation is that a senior business development employee misused internal company dashboards to surveil the private wallet activity of prominent crypto influencers. Because Axiom lacked strict access controls, this employee was able to track what these influencers were doing and front-run massive meme coin trades.
Unbelievable.
Now, Axiom did step up. Their CEO confirmed the breach. They immediately revoked the employee's access, and they assured everyone that user funds and private keys were never compromised. But the damage to trust is done.
Let me explain why this is so insidious, especially for you listening. In Web3, the ledger is public. Everyone can see every transaction. But the metadata matching a specific wallet address to a specific human being or IP address is highly sensitive.
Right. It's the bridge between the anonymous numbers and a real person.
Exactly. If I work at the terminal you used to trade, and I can see that your whale wallet is about to buy $10 million of a token, I can buy it a split second before you do, let your massive purchase drive the price up, and then instantly sell my tokens to you for a profit. That's front running.
And it highlights a recurring structural flaw in this industry, right?
Totally. You have these rapidly scaling startups that are prioritizing hyper-growth and shipping products fast, but they're doing so at the expense of basic corporate governance and compliance safeguards. They are building financial infrastructure without the basic access controls you'd find at any entry-level bank. It's a stark reminder that in this industry, asymmetric information is power.
It's the Wild West, and sometimes the outlaws are the ones building the saloons. I should note, this happened the same day a bipartisan bill called the Promoting Innovation in Blockchain Development Act of 2026 was introduced to protect software developers from certain prosecutions.
So the guardrails are coming.
We are seeing legislation try to catch up, but basic corporate hygiene is clearly still lacking. Okay, we've covered a tremendous amount of ground today, from DAO drama to global macro tariffs to the tokenization of the stock market. So let's bring it all together. What is the ultimate takeaway for our listener?
It all comes back to separating the signal from the noise. And the noise this week was deafening. The daily price volatility, the extreme fear indices, the cascading $500 million liquidations.
Hard to ignore.
It is incredibly easy to get shaken out by that. But the true signal, the thing you should actually be paying attention to, is the unrelenting pace of institutional adoption and structural maturation. The fact that stablecoins are preparing to integrate into major social networks like WhatsApp and Instagram, the fact that we are seeing real regulatory clarity emerging through legislation like the Genius Act, and perhaps most importantly, the fact that crypto exchanges are successfully building the infrastructure to absorb traditional equities.
So based on all of this, what should our listeners be watching next week?
Keep your eyes locked on how traditional Wall Street regulators react to Kraken's tokenized equities and Coinbase's new stock features. Wall Street doesn't like giving up its monopoly, so that is going to be a major turf war.
No doubt.
Additionally, keep an eye on Aave and the broader DeFi ecosystem. Watch to see if they can actually solve these centralization and governance issues as they scale, or if they end up just recreating the exact same corporate bureaucracies they swore to replace.
That is going to be fascinating to watch unfold.
And I want to leave you with a final thought to mull over as you go about your week. We've talked about exchanges offering 24/7 Apple stock and stablecoins powering WhatsApp payments. If this structural blending continues at its current pace, if crypto seamlessly absorbs traditional stock trading and handles the back end of social media commerce, will the average consumer in 5 years even know they are using a blockchain?
That's a great question.
Or will crypto simply fade into the background, becoming the invisible, frictionless plumbing of all global finance, much like the protocols that run the internet today? You don't think about TCP/IP when you send an email. Soon you might not think about blockchain when you buy a stock.
The greatest success for crypto might just be its own invisibility. That is a fantastic thought to end on. Thank you so much for joining us for this deep dive into the source material. We love unpacking these complexities with you and hopefully making the fire hose of news a little more manageable. If you want to stay ahead of the curve and get the news as it happens, be sure to follow Nifty Noon on X and subscribe to our newsletter on Substack. Until next time, stay curious.